Just a quick disclaimer before starting the webinar that whatever the stock ideas that we'll be discussing through the course of this webinar. So this is just for the educational purpose, and do your own research before investing in the such companies or consult your financial advisor. So now starting with the webinar today. So we have chosen an interesting topic, right? Considering we are in the midst of an very volatile economic environment, right? And we have seen the information flow happening and the news flow happening in the last 1 year, where we have seen something like Russia-Ukraine war, then runaway inflation, and then Fed going on the tightening the leash on the inflation by raising the interest rates and all. And recently, we have seen the collapse happening in the US and European markets. So collapse of banks happening in the US market. So mainly, there are so many events which are happening and they have a bearing on the short-term market performance. But in between all those things, we lose track of our long-term investment goals, right? So it becomes very important for us to be cognizant of the fact that in the situation where there's a mispricing, that's mainly because of some macroeconomic event, we are able to find the securities and the businesses which are available at a discount to their intrinsic value. And from here on, if we'll continue our investment journey. So over the long term, we are able to see a meaningful wealth creation happening. So with that, I'd like to start the presentation. If we can just move to the first slide, Prabhu, please. So just starting with that, there are different investors invest across different asset classes and categories. So just to put things into perspective, if somebody is invested into the debt funds for next 10 years, right? If he has invested or over the next 10 years. So mainly the return expectation that he can expect is at max he can double the wealth that he has invested into the debt funds, right? Similarly, if somebody is a slightly more aggressive, but again choose to invest in the large cap side, so he can actually triple the wealth over the 10-year horizon. And similarly for the mid caps and small caps, the wealth creation could be 4x and 5x, right? But to grow your wealth 10x by over let's say next 10 years, so you need to do something different, right? You need to deliver alpha of 8% over the small cap index. And that's not an easy task. Some investors have done it in the past. For example, there is a very famous investor, Peter Lynch, who used to run Magellan Fund. He delivered a return of 29% CAGR over 1977 to 1990 period, right? So we share some of those findings, how you can go about the structured investment process, right? You need to have a framework in place so that you can target those sort of abnormal returns. So just to discuss about certain pockets of investments available to one. So if you can just move to the next slide, please. So if we just try to put the stocks in terms of growth and valuation. So we have something called value traps in the market where the valuation is very on the lower side, but again, the growth is not there in such companies. So such companies are typically your power companies or infrastructure companies, cyclical companies, right? Or the companies with very poor management track record. So such companies typically are available in a single digit P or at max, low teen P. But typically there is some announcement around those companies that the order book, the company is more than the market cap. So this company is going to generate wealth. But because of the poor execution track record of the management or some sort of government overhang, the execution never happens, right? And the earnings visibility is never there in such companies, right? So these companies are absolutely wealth destroyer, and at any cost we should be avoiding such companies, right? We should not fall prey to such companies that they are going to make the meaningful return for us. Similarly, there are some companies which are which have moderating growth, but they have very high valuations, right? So these companies are darling to the market, and everybody knows about such companies. These are typically your quality oriented companies where the market caps have more than 50,000 crore, or even at the lower market cap we can find such companies, but the one common trait is the valuation is at more than the normal industry valuation levels, right? So typically the compounding that one can see in such companies happening at the rate of the earnings growth. So mainly whatever the earnings growth being given by such companies, the similar sort of stock price growth one can see here. And at max you can grow your potential portfolio by 10% to 15% to 20%, not more than that. The third set of companies which are available in the market are basically your multi-baggers. Now here, the valuation is slightly at a discount, right? So mainly you have slight valuation comfort, but the growth trajectory of such companies are very rapid, very fast in the future, right? So mainly here we have the growth prospect, very promising growth prospect for such companies, and the valuation we like potential valuations are quite comfortable in the market. So if we can identify such companies where the capital allocation or capital efficiency is there, so we are going to make meaningful returns in the future. So just to showcase this through an example, like what we have replicated here at Right Horizons. So if you can just move to the next slide, please. So here is a case study from our portfolio Super Value that we managed, that we are managing here. So mainly this is the portfolio stocks from FY19 to 22. So we bought the stocks at some point in FY19, 20 and 21. So the Super Value has delivered a CAGR alpha of 30% since its inception, and whereas the index is trading close to around 20%. So mainly we have delivered alpha of 10% by following a framework that has helped us to get this multi-baggers in place, right? So the typical thing that you will see that all these stocks have given 4x to 6x kind of return for us, and the reason why they have given 4x to 6x kind of returns mainly because if you just go back and try to break the returns into two parts. So the one part of the return is mainly your growth part. So how the earnings growth is happening, and earnings growth is a factor which is very common to all of this, the 1.5x to 2x kind of earnings growth we have seen that happening. Now, the return generator, the main return allocator was your multiples. So mainly if you look at the multiple that we have entered into something like IRCTC when it was trading at a 35p, and when we exited the company, it was trading close to 105p. So there was a 3x kind of multiple rating the company has gone through. So when you multiply 3x of multiple rating with 2x of earning growth, we are left with 6x of price return from the company. So this is the secret of identifying the multi-baggers, that you go for companies with higher earnings growth, and this is actually the controllable factor. Being an investor, you can actually project the earnings growth depending on the management commentary and your understanding of the company, but how the company will do in terms of valuation. So that's again being controlled by a lot of different factors. So always we have to take note of the fact that the valuations are in comfortable range. So let's say the sector is trading at a multiple of 50p. So we have to identify something or some companies which in the sector which trades at let's say around 25p or 30p. So we don't want to overpay for the companies so that we don't compromise on the future growth in the price. So this is what the formula was, and my colleague Vijay will also be discussing about some of the key themes that we will be we have onboarded in the portfolio now, keeping in mind the next full cycle. So just to move ahead, where we have to look for such companies. So the one common trait for all these companies are either mid cap companies or small cap companies, right? So let's understand why mid and small caps seems very important as a growth, as an investing avenue for now. So if you can just move to the next slide, please. So apart from all those historical data that we have, one common thing is the valuation, right? So if you compare the large cap valuation with respect to the mid and small caps, so the valuation level for large caps is it is trading at a discount of 5% to the long-term averages, while mid caps is today trading at a discount of 7 to 8% from the long-term averages. But the carnage is mainly done in the broader market, which is the small caps, where the valuation is down roughly 35 odd percent, right? So for those who are new to the market, if we have to categorize the market across different caps. So mainly we have the large cap, which is top 85 percentile of the market. Then we have 85 to 95 percentile as the mid caps, and then 95 percentile to 100 percentile as a small caps, right? So the one common factor, the companies which are in the small cap is that these companies are not well researched, right? And they have very less institutional presence. The business models are not established here, right? Where you look at the large caps and the mid caps, the business model are somewhat established. So the chances that you'll find a mispricing becomes exaggerated in this segment. So the typical sweet spot where to look for the companies for multi-bagger return for at least for us is 500 crore to 20,000 crore market cap. And the one more reason to look for such companies is that these companies represent the wider area of economic growth, right? So mainly if you look at the Nifty, so normally 65%, 60% kind of weightages is given to something like energy, financials, and IT. But if you look at the something like small cap index, so mainly a lot of weight is distributed across a lot of small industries and sectors, right? So typically there we can have an industry which is itself 2,000 crore or 4,000 crore of industry, but then the leader is commanding a 60% market share, and mainly because of the innovation done by the leader, the industry itself is growing at a 20-25% CAGR, right? But we can't have that same growth rate in the sector in the large cap space, right? Mainly because that sector has matured over the years, and it is well discovered, and the growth will not be there in such segments in the large caps. So, but the small caps come with their pitfall, right? So if you can just move to the next slide, please. So if you look at something like small caps, right, and if we try to invest in the period of economic downturn, so the chances that you will also be ending up losing money, right? So there is a good 5% chance looking at the last 19-20 years of data that you will be like the small caps will be wiping 50% of your wealth. But the potential to make money is actually 2/3 in the small caps, and what the last 19-year data showed us that 68% of the time the calendar returns actually is positive for those companies in the smaller caps, right? And if you are targeting that magical number of 26% compounding, so there is a 50% probability that companies from the small cap space will deliver that magical number to you. So being an investor, then it will be your responsibility to not go for the companies which are not sound, or which have shady management or broken balance sheet. Rather look to identify the companies which are at good valuation levels and have robust business models. So in this next slide, I'll show you that how the probability is there attached to the top quartile. So mainly if you look at the entire small cap return, so over the last 15-20 odd years, the small cap has averaged around 16-18%, right? But if you look at the bottom quartile doesn't make any money. So out of the 1,000 companies which are in the small cap space, around 750 odd companies have not made any money for the investors, right? So there's a large portion in the small cap is very treacherous, and investors often tend to lose money by investing in those segments, right? And if you look at the average return of the bottom quartile is just 2.2%. But if you just focus on, if you have a process in place where you can focus on identifying the companies which are in top quartile and which have good management, good business model, proper capital allocation policies and all. So the average return in that segment is close to around 32% or 37%. So with that, I'll invite my colleague Vijay to discuss you some of the internal frameworks that we have in place and some of the major themes that could become a potential multi-bagger for us going ahead. So over to you, Vijay, now. Thank you.
Yeah, thank you, Prabhat, for taking us through the SMID importance and the magical number. So now we will move on to the next section, which is the investing framework and application of the investing framework. So first we will go to the investing framework. So at RH, we have developed our internal multi-bagger picking framework. So it has two legs basically, which combines a growth and value factor. And we will discuss independently like how those factors can contribute to generate multi-bagger returns. And both of them are mandatory to generate multi-bagger kind of returns. It's not like presence of one will dictate the multi-bagger return, but combination of both will lead to the multi-bagger returns. So starting with the growth factor. So whenever we are picking any business in our portfolio, so what we are trying to look in terms of growth is quantum of growth and the quality of growth. So by quantum of growth, what we mean is basically the earnings should double in next 3 to 5 years period that we are ideally targeting. And the growth should be more than the industry growth and also the industry leader growth. So let's say if we are investing in debt fund, which are generating 7 to 8%, or we are putting in FD, which is giving 7 to 8% kind of range, depending on various banks. So we should be able to generate additional return over that because we are investing in equity, we are taking additional risk. So there should be always some risk premium, like the quantum of growth should be at least 12-13% comfortably over next 4 or 5 years. And second part is the quality of growth. So quality of growth can be defined by two parameters. One is the durability of growth and second is the longevity of growth. So durability of growth is basically the how volatile or how stable the growth quantum of growth is. Let's say if the company is growing at 20% growth rate, let's say in any calendar year period. So how much it is volatile? Can it keep on compounding 20% for the next 5 years, or is it volatile? Let's say it's giving first year 20, or second year it's giving 15, and now in the third year suddenly it's in negative track. So we check for this durability. It should be very consistent one. And the second parameter of quality of growth is longevity. So in longevity, we focus on for how long the company can compound at, let's say, 20% growth rate, so that it doubles its earnings in next 4 to 5 years. And these two factors of quality of growth, which is durability and longevity, basically those are visible into the form of moats. So whenever we study any business, we try to identify the moats, or in plain language, competitive advantages. So I will take just one example from our previously discussed multi-baggers. The one example from the specialty chemical side, which is a Neogen Chemicals, which we used to hold. In 2019, we onboarded the business and we let go of in 2022 because the disease has already played out. So when we were like looking at the specialty chain almost in 2019, it's a very complex sector because it requires certain level of expertise to understand how the value chain works in the specialty chemicals. So what we did was we tied up with one of the IIT professor, and he helped us to understand how the value chain for the specialty chemical works, and it helped us to understand where the real potential or which kind of companies have moats. So we met the management of Neogen Chemicals and we understood their vision of expanding their capacity in couple of years. And so we understood the company had potential to double its earning in next 4 to 5 years period. So one part was done for us, which is a growth. It had crossed our filter criteria of around doubling of the earnings in the next 4 to 5 years. Now we moved on to the second part, which is a valuation. So for us, any company whom we are trying to pick in our portfolio should have reasonable margin of safety in terms of valuation. So the margin of safety comes from the valuation at which you enter in a particular business. Let's say like if the sector is trading at 50 XP and industry leader is trading at 60 XP. But if we are able to identify an emerging leader or some new company which is trying to mimic the industry leader and it's available at 25 XP, so we already have the 25 XP discount, which is a 50% discount to industry multiple. So that is called the margin of safety. So the valuation comfort we always seek whenever we are buying any company. So in case of Neogen Chemicals, when we were picking this business in almost 2019, the 1x forward P for the business was around 20 XP. And we were expecting the P to cross around maybe 50 to 60 XP once their plant comes online in next 4 to 5 years, and the earnings also double in that due course of time. And that is how we envisioned that the company should be able to generate at least 2x from the earnings side and 2x from the valuation upfront side. So approximately we were expecting 4x kind of return on the conservative side, and we were able to achieve almost 4.5x from the particular business that is the Neogen Chemicals. So the idea over is that the multi-bagger returns not only come from either the growth investing or the value investing. The probability of generating multi-bagger return improves or increases drastically if we are able to identify the emerging leaders which have a solid growth potential but at reasonable valuations. So that is how we have mastered this multi-bagger framework, which we applied in the previous bull cycle, and we are also applied into the upcoming bull cycle that we are preparing in. But as we know that when we are chasing a multi-baggers, we also need to look at the other side of the coin, which is a risk management framework. So at RH, we have developed our strong risk management framework that we always look into the part when we are looking at the multi-baggers. So here we look at mainly the three sorts of risk basically. The first is the business risk, second is the valuation risk, and third is the corporate governance risk. So first factor that when we look at from the risk side is the business risk. So what we try to do, or let's say what we try to avoid the companies or businesses with unpredictable earnings, or let's say the cyclical companies which are like having a solid growth in next couple of years, and once the downturn comes, so your operating leverage goes away and you start to make losses or your margin collapses. So we strictly try to avoid such kind of companies. Also, we avoid companies where we see their competitive advantages are not structural in nature. They are just there because of some sort of tailwind which is coming from the industry side. And so we don't like such companies which are going to do in, let's say, good in maybe 1 or 2 years. But let's say from third, fourth year and onwards, the competitive advantages will vanish. So we strictly avoid such kind of companies. Second is the valuation risk. So for us, any business that we are picking in should be a very reasonable valuation. It should be always discount to the industry multiple, or at least the industry leader multiple, because that is how we will gain the margin of safety. So we don't like the companies with high P, which are not justified by the growth. We will always pick a business which has a high growth but at the reasonable valuation. And the last is the corporate governance risk. So at RH, we primarily focus on the corporate governance framework from the promoter side, and also we run our internal checks from the indiaqanun.org, which help us to understand any legal litigations pending against the company. And we don't pick businesses which are like not management, like not the minority investor friendly, or the management is let's say skeptical and not being transparent with the minority shareholders. And also the capital allocation decisions which are taken by the management, ideally let's say the 4 times in a year when the quarterly result comes. So we always critically look those capital allocation decision. So, and if we feel that, or if we find the evidence that the capital allocation for the future growth is not as per what we have developed in our investment thesis, so we will part the ways with the particular business. So that is how we focus on the 3 sources of risk: business, valuation, and corporate governance, which increases our probability to deliver a multi-bagger returns. So that is how our whole investment framework lies between the risk, balancing between the return and the risk part. Now that we have understood how the what is the multi-bagger framework and how we can keep the checklist of sources of risk during this journey of multi-bagger, now we will look at the application of this framework in the recent time and how we can benefit from the recent scenario of, let's say, the stagnant market or the low P valuation that we are getting in currently. Yeah, so we'll move on to the next section where we will discuss the application of this framework. So what we did in the recent time, so in the last year, FY22, basically calendar year 22, we let go of some of the previous cycles multi-baggers like Neogen Chemicals and other names which my colleague Prabhat discussed, and we started to identify the next multi-baggers in our portfolio. So what we did was, this time we tried to look the little bit wider perspective. We tried to study the different developed markets who had a GDP per capita more than the India. So India has around $2,300 GDP per capita. In this chart, we have captured the data as of May 2021, which is around $2,000 per GDP per capita. Somewhere we are around $2,200. So we studied the business with the countries who have already been passing through the phase of, let's say, the $2,000 per GDP per capita to $5,000 per capita income per GDP per capita, and later on moving to the 6,500 and 8,500 GDP per capita. So what we found out was, when the country crosses the $2,500 GDP per capita mark, or let's say when they are going from $2,000 to $5,000 per GDP per capita side, so we expect, we normally have seen the 3 types of booms in the market. So first is the credit boom in that particular country, because as the individual's income keeps going up, so they start to borrow against their future income. So we will witness a credit boom. Second is the construction boom. So construction can be from the real estate side. People will start to buy their own houses. People will move towards the nuclear homes. And second is the manufacturing, or let's say the infrastructure building side, like the building of roads can be accelerated, building of railway stations can be accelerated, and most importantly, the airports will be built up in this journey, like from $2,500 to $5,000, because normally the people can afford now to pay for the flight tickets. And the last boom, and the last is consumer discretionary boom. So once people have enough money in their hand, so the residual income, they will start to invest in the mobility side, or let's say the apparel side, choosing the good lifestyle, having the car, those kind of things, which are the discretionary items. So we identified these 3 booms: credit boom, construction boom, and the consumer discretionary boom, 3 C's of the boom. And based on that, we try to find out, we try to bottom up the companies which are present in the Indian domestic market, and we identified some of the themes that we onboarded in recent time for the next upcoming upcycle. But while we were onboarding this different themes from these 3 booms, which are the 3 inherent tailwind, we were also taking care of the infrastructure boom side, because when we are dealing with the infrastructure company, we are also doomed by the low ROE and the high working capital requirement which by the company. So we strictly avoided companies which have high working capital requirement or low ROE by nature, like mainly the EPC companies we never onboarded. So we onboarded companies which have lower working capital and higher capital efficiency. So now we'll discuss or highlight some of the key themes that we have already picked up in our one of the portfolio. So please move to the next slide. Yeah. So so for the next 5 years, how we are looking at it, like we have been through the one bull cycle from FY19 to FY22. We had a good bear run in FY23, almost flat or negative returns for more than 18 months now. And what we are expecting is like we can have again a one bull run, depending on the lower valuation and high growth pockets that we have already identified. So there are 6 different themes that we have highlighted in this table. So one of them comes from the paint side, wires and cable side, electronic retail side, steel pipe side, fashion retail side, and NBFC side. So all these are linked to the 3 booms which I have already mentioned, like credit boom, construction boom, and your consumer discretionary boom. So what we did when we were picking the new multi-baggers for the next run. So as we did in the last bull run, we studied the Neogen Chemicals in depth and we onboarded with a solid weight in our portfolio. This time also we replicated the same process. So one of the company from the electronic retail side. So when we first met the management around 4 quarters back, 3 or 4 quarters back, the company was telling that they were planning to increase their stores from 80 to 150 in next 3 years. So we were quite surprised with the growth projection that they were building in. And the company is present, or the business operates in the East Indian territory, basically Bihar and all these Jharkhand area. So you are very skeptical because the GDP per capita is relatively lower for the country, for the states which are in the eastern side of our India. So when we met the management, so management helped us to understand the modes they were trying to build in and the vision that they were carrying of reaching 150 stores in next 3 years. And quite surprising to us, they had not even closed a single store since their opening. So whenever in retail, we will see the non-performing store are closed by the management. But for them, the failure ratio was almost zero, actually zero in that 80 stores which they opened in the last 10 years. So we like the vision. But for us at RH, vision without execution doesn't lead to the multi-bagger returns. It always leads to some sideways returns or normal or subpar returns. So what we did was we tried to understand the execution potential from the company. So what we did, we went to the Bihar state and we carried out our in-depth survey of visiting the stores of that particular brand, and we tried to understand from their clients or the dealers whom they were selling the third-party items like mobiles, TV sets. And we also did the customer survey, like how they were perceiving the brand or what kind of value they were offering. And we were satisfied with the findings that what the management was speaking, it was also visible in the ground level execution. And if you look at the valuation multiple, so it's trading around 15x P EV by EBITDA. And if you look at the sector, it's trading at almost 45x P EV by EBITDA. So the discount is around 66%. So if we look at the conservative side, let's say it doubles its earning in next 4 to 5 years, and the valuation, which is at discount at 66%, if it goes up by 3x, so we can expect around 6x kind of returns or implied returns from this particular business. But we would like to stick with our conservative framework. So we are even happy if we are able to achieve, let's say, 3x kind of return from this investment. So that is how we have carried out the independent research for every of the companies that we have picked from the different segment side. Of course, because these companies are part of our portfolio currently. So as per compliance, we are not allowed to disclose the names. So we have just captured the industry and we have talked about one of the company, that how we carried out the research. Actually, the depth of research will lead you to the multi-bagger returns, not some top level view, because the maths is quite simple. If you look like if we can get 2x of earnings and 2x of multiple rating, we can generate 4x growth. But it may sound simple, but implementation is not simple. It's not easy. we need to have right mindset also to generate a multi-bagger kind of return. So at RH, we don't only rely on the financial analysis. We also have adopted the right mindset when we are dealing with the multi-baggers. So that we would also like to discuss so that it can be helpful for everyone. Yeah. Moving on to the last slide, please. Yeah. So at RH, like as I mentioned, we are looking at the both side of the coin, financial analysis plus the right mindset. So why right mindset is important? So basically, we have captured into the three different key points. Like the first point being be patient and disciplined. So what we need to understand that market is just a place to buy and sell shares. Okay. So market swings like price going and up doesn't determine the company's potential. Actually, it's a opposite way. What the company is doing in terms of business operations, like I mentioned in the Neogen Chemicals, they were opening a plant, new plant in the Dahej side, and they were expanding their capacity. So that was going to determine the future of their stock price in the 2022. The stock almost went up from 400 odd rupees to 1800, 1700 odd rupees. So the future was determined by the business operations, not the daily price fluctuation. Second thing, in the same point, like the volatility, real volatility is not the market volatility. Of course, like in case of Neogen, it had went up from almost 5x from its initial price point. So the volatility will be always higher than the market, but you should not be worried by the higher beta of that stock. You should be focusing on the cash flow volatility or the business model side. So if your cash flow is strong enough or robust in terms of execution, so your stock price will also be a stronger, and let's say the re-rating will also be a stronger, and it will be much more than the market, like in case of Neogen Chemicals. Second point that we need to keep in mind is to think long term. So what we mean by that? Even the six themes that we have picked. So one of them is trying to increase their store count from 80 stores to 150 stores, and right now it has already crossed the 100 stores mark as they released their last communication. So we are almost 3 quarters since we have onboarded the company, and the execution is taking place. But again, it will take some time to open those 50 stores. It may take 2 years more to story to unfold. And as we already seen in the case of Neogen Chemicals, the plant was going to open in the 2019, but the ramp up of the plant happened only in 2020-21, post-COVID time, and the major re-rating happened during that time. So we need to keep that mind. The journey is journey has its up and down, and it's very difficult to keep your mind focused when the prices are changing on the daily basis. And if we look at the results, so result only comes once in a quarter, that is 4 times a year, that's all. But prices, it's a 250-day trading days, it will keep changing, it will keep bogging us that something is happening with the company. Stock is falling by, let's say, 3-4%, or we should not be excited if the stock is going down by 4-5% without any improvement in the underlying results. And the last part is the focus. So what we have seen, like it's a very arduous task if you want to focus, if you want to predict the future of, let's say, the Nifty 50 index or Nifty Midcap 100 index, because we have to study the 50 different business models, or in case of Midcap, we have to study 100 different business models, and then try to project how their cash flow would look like in the next 5 years. So it's a challenging task, it's an arduous task, and it's a time consuming task. So the guess or the educated guess that will come from studying the 100 business will have always less probability of being right versus studying a single business model in depth and predicting its future. So at RH, we pick such kind of 20-25 businesses in our super value strategy, which we have discussed some of their themes, and try to go into the depth to understand the promoters' vision and how they are executing in terms of ground, and that help us to get a superior risk adjusted return. So that we combine, let's say, the financial analysis and psychological part in one key RH multi-bagger framework. And lastly, as we discussed, the journey of India from $2,000 odd GDP per capita to $5,000 per GDP per capita will be volatile one. Like in the recent time, we have seen the market has not moved up anything in the last 18 months, is almost negative for some of the issues from the credit side. So there will be similar issues in going ahead, but the journey will be very rewarding one for all the investors who become part of this and invest during this crisis time. And if anyone wants to be the part of this multi-decadal wealth creation journey, you can always join us. And with this, we would like to conclude this webinar. And thank you so much for listening us patiently during this Saturday morning. Yeah. Thank you, and over to you, Prabhu.
Yeah, thank you, sir. So we'll begin with the Q&A session. So one of the participants has asked, do you think one should top up now or, wait for the markets to correct further? And whether should one prioritize investing in small caps as of?
Yeah. So as I have presented, that if you look at the valuations, right, especially in the small caps, so the small caps are trading way below their long-term averages and specifically at a discount of 30 to 35%. So if you look at, there are a lot of negative news which are hampering the market performance of this particular segment, right? But if somebody has a long-term view, so this is an ideal time to start building a portfolio in the mid and small cap segment. And with that, there is a caution from our side that we understand the market could be volatile 3 to 6 months, mainly on account of all the news flow that's happening. So this next 6 months could be a volatile one. So investors can take their time to stagger the investment in the market. But if you look at the long-term potential for these investments to grow, so every 1 rupee invested today in the small cap has the potential to actually double in the next 3 to 5 years, right? Mainly because whatever the valuation discounts we are seeing in the market today. So yeah.
Yeah, thank you, sir. So the next question is, do you see the rate hike cycle picking up or the inflation coming down?
So on the rate, we have gone through the comments by the Fed chairman, right? So the 25 bips hike that we have seen, this is the second last hike, right? And after that, we probably will be seeing one more rate hike. Reason being that whatever the inflation print that we are seeing currently, so that is going to get normalized in maybe next 3 to 4 months time frame, right? If you look at the last 6 months average inflation print that we have seen in the US market, so mainly it's around 4-5% only, right? We are not seeing 6% kind of inflation happening in the last 6 months. So mainly the spike was there in the US market till last May or June, right? And then one spike happened in the month of September, right? But after that, the inflation is on again to the normalized levels. So we'll move ahead in this financial year, right? So we'll see the spike getting to normalize, and that will be a more of a reason for the Fed to cut the rates, or at least not go ahead with the rate hike, right? And from there on, maybe next year or later half of this calendar year, we'll see again some rate cut also happening. That will be again a good boost to the market. Speaking about the domestic market, so mainly we don't see any as such reason for RBI to hike the rates, considering we have the inflation which is not abnormally high, right? But just to control the volatility in the currency market, the hands of the RBI also tied. So basically they also have to hike the rates just to match up with the Fed, right? But speaking about the domestic inflation environment as well, so we'll see the normalization happening very soon, and maybe from June onwards or April onwards, we'll see the prints coming back to below 5% mark, closer to 4.5% or 2% mark. So yeah.
Yeah, thank you, sir. So the next one is, so regarding the rate hikes itself, so do you see any material impact on banks, earnings due to the rate hikes being at peak levels?
Yeah. So with the rate hike, we are not very much, we don't see any material impact happening on the bank side, especially on the Indian bank side. Because if we talk about the asset liability mismatch or the duration mismatch, which happened with the SVB in the US side, so in India, we don't see any material challenges, because RBI has been has already done its job in way back in 2015-16 when they launched the asset quality review and they cleaned up all the banks. So our regulations were very strong. Almost now 8 years it has been during that event, and the credit quality has drastically improved, and also the asset quality. If we look at the even the public sector banks, those are like very good. Like if we have to identify almost all the private sector banks, large private sector banks have less than 2% net NPA, and even the some of the public sector banks have now less than 2% net NPA. And as we have discussed, the long-term trend of, let's say, the $2,000 per GDP per capita to almost 5,000. So the credit boom will be 1.4 times of the GDP growth. So let's say our GDP in terms of real GDP, let's say it's 6%, inflation is 5%. So your nominal GDP is 11%, 12%. And above that, the credit growth will be 1.4 times of that 12%, which will be somewhere around, let's say, 16%, 16% on the conservative side. So we will see a huge run of for all the credit related businesses like banks or NBFCs. And based on that, like, we also picked up one of the business which is trying to mimic the leading NBFC. It's basically based out of Pune, and so we are quite bullish on the NBFC side. There can be some impact in short term in terms of, let's say, the recent panic which has been caused by the SVB and Credit Suisse event, but we don't see any major material impact due to the rate hike cycle going ahead. Yeah.
Thank you, sir. So the next question is, so what are the future themes that you're looking at for the next multi-bagger?
Yeah. So as we discussed, so we always take our decisions based on the evidences that data or information present to us. So like the GDP analysis, which we highlighted in the one of the slide. So it clearly tells us three things, that India is going to have three kind of booms. First is credit boom. So any good NBFC or any good bank available at reasonable valuation. And mainly when we are picking an NBFC, we should not focus how they are going to grow. We should focus how they are going to recover their money. So banking is not about like giving the loans. Banking is always about like how much money you can recover, which you have already lent. Let's say you have given 100 rupees. So the bank who will recover 99 rupees, you should always go with that. Not the bank which is growing, let's say, at 40% growth rate. But out of 100 rupees which they have lent, they are only recovering, let's say, 95 rupees, and they are losing 5 rupees. So you should always go with the bank which is recovering, let's say, 99 or 98 rupees out of that 100 rupees. And they are growing, let's say, comfortably around 16, 18% kind of growth. So that can become a solid multi-bagger if you take a view of 5 or 10 years. The second boom that we see is the construction boom. So any company from the wires and cables or paint side, or let's say the housing theme side, like PVC pipes or steel pipes, those can be very rewarding one. So one can do their own analysis while looking at the particular business, and you inherently have very natural tailwind from this side. So one can pick some small and mid cap or consult their financial advisor regarding it. The last one that we are very confident of the consumer discretionary side, because once people acquire necessity, they will try to spend behind the discretionary item. Spending on the apparel side, spending will increase on the, let's say, the entertainment side, spending will increase on the, let's say, the auto side. People will start to own four-wheelers, or let's say move to the flight tickets and all. They will be their income will help them to afford those luxury items, or the discretionary items which they were not able to afford earlier because of their low income. So these three booms, one can look for picking any businesses with strong visionary execution from the promoter side, and mainly the solid corporate governance will help us to get you some of the multi-bagger returns. So these three themes, one can be a starting point, and later on one can dig into the individual businesses. Or in case if you need any help, so you can always join us, like the strategy that we run. So one can always come back to us, and we'll be happy to help you over there. Yeah.
Thank you, sir. The last question is, gold has outperformed the asset classes in the last year, and is there any steam left for the yellow metal to continue?
Yeah. So gold, like, as an investment class, it has not performed well across the cycles. But normally when, when you look at the situation which is currently, like when we are in the middle of a economic crisis, So mainly like, due to the flight of safety, the commodities like gold, normally like, tends to outperform the equities, right? But if you look at the long-term returns and compare that with the equities, so normally like, they underperform by 3 to 4%, right? Coming to the point whether it makes sense to invest in the gold now. So I think we have seen most of the rally, which is there to happen in the gold, right? This year, considering it would be a volatile year, gold is expected to perform, but the performance of the gold will be in relation to the equity, right? Nothing major outperformance we are expecting there. Plus, we also have to think about the taxation, right, that comes with a gold, because there will be higher taxation if we'll be holding the gold for shorter term. And in that case, if you are going to hold the gold for longer term and get the indexation benefit, so maybe the cycle will reverse, and whatever the gains that you have, gains for there in the portfolio, that will also go away, right? So it's a very tactical bet. You have to be very smart in entering into the gold or some other commodities, and you have to exit at the peak. Otherwise, when the cycle will turn, will lose all the returns there. We have seen that happening during the COVID also. The investors who have invested in the gold somewhat later in 2020, so there was no such meaningful return to be made there, right? So you can invest in the gold as a hedge against equity, right? But not as a investing in gold more than 5% or 10% of the portfolio. So that's not going to add any meaningful return to the overall portfolio return. That's what thought is. Thank you.